Hi everyone, we're back at it post Labor Day. US Open still going on for this week, but BarCap conference, major conference, energy conference here in New York is the other big feature, and I'm actually going to change this shirt and go and wear a decent shirt and meet the CEO of EOG for drinks tonight. Tomorrow night we'll be hosting drinks. I'll be sending you a location for early 4:30-ish, even 4 o'clock drinks tomorrow, so that you can get in before you have a company dinner. If that's what indeed you are doing in New York City right now, which a lot of investors are. We had Halliburton talking today. You've seen comments from BP. But obviously the big news in oil is the Saudi extension of cuts that have been announced. Very sort of well expected extension of cuts and fairly predictable spike in oil. Our Sunday note was basically saying you want to sell the news, and you know the initial spike did sell off a little bit here. Certainly from the point of view of equities, it's difficult for the oils to discount sustained Saudi cuts, because that overhang of spare capacity simply isn't catalyzed by the market. Now, of course, things are a bit different now because a lot of these companies have special dividends and other oil price sensitive payouts. So there is even if it only lasts a couple of quarters for Saudi to maintain super high oil prices, you know, where would they be? Where would oil prices be without the Saudi cuts once the US SPR rebuild rolls off? You know, assuming that Russia is struggling to produce, it's all worth about 1.3 million barrels a day at the margin of essentially overhang, depending on how you view the SPR rebuild, which is not that big and is going to be ended by September. You know, what you're really seeing here is the impact of 1 million barrels a day of Saudi cuts right through December, and that will tighten the market from the crude side. The key unknown is the extent to which high Chinese imports of crude are firstly a problem, because a lot of the Saudi cuts are being replaced by Iranian barrels, and the US administration seems to be switching away from using the SPR because they've kind of used that option and are now working harder to bring Venezuelan and Iranian barrels into the market, which is a worst case scenario for Saudi essentially, because if the oil price starts to weaken with them at very low levels of production, then you potentially get a problem. And the market, I think the oil market is going to worry about that, which is that if we do get a sustained weakening in oil prices, what does Saudi do then? And then of course you're into the situation where you get down to the kind of 50-60 numbers that we've been talking about for February next year. In the meantime, demand is holding up, as you can see in refining margins. But again, this week we're highlighting that refining margins have taken a big rollover to very high levels from super high levels. But the dynamic has looked very negative for the past week or so, right across the whole board from Asia, Europe, and into the US. So refining is our leading indicator for how much we like the oil market, and our view is basically that you sell the Saudi cuts. Okay, we'll come back when we've got more oil company specific stuff, which will be coming out this week during BarCap. I hope you have a great week. We're back.